What's up, guys? It's Vlad here, and today we are diving into another key concept in ICT trading, the inversion fair value gap, or IFVG. We're going to cover some key elements such as what is a fair value gap, what is an inversion fair value gap, what is the use of an inversion fair value gap, and finally, I will share with you my personal favorite IFVG model. And without further ado, let's not waste any time and get right into it. What is an inversion fair value gap? First of all, we need to understand what is a fair value gap. And fair value gap is an inefficiency in price delivery where only one side of the market, either buy side or sell side, is delivered. An inversion fair value gap, on the other side, occurs when that original fair value gap is later on balanced by price delivering through it in the opposite direction. So price is delivering the opposite side. For example, if we have a buy side fair value gap or a bullish fair value gap, price needs to deliver bearishly through that fair value gap in order to balance it out. Once balanced, it is the fair value gap no longer acts as a simple inefficiency to fill. It transforms into a balanced price range and acts as an institutional reference point that should now be respected and used to send price in the opposite direction. And as you see on the example on the right, the bullish fair value gap, once we balance it out with bearish candles, then that level starts acting as an inversion fair value gap or a level of resistance in order to send price lower. Okay. So what is the use of inversion fair value gaps? First of all, to find institutional levels of support and resistance. Second, confirm market structure shift. Filter out fake market structure shift. And also find high probability setups. So finally, I want to show you my personal favorite IFVG model. And let me explain it to you, and then we're gonna deep dive into some practical examples, okay? The key elements to look for. First of all, we need to have a purge of liquidity, okay? Second of all, there should be a displacement before the purge occurs. So you can see it on the graphics on the right, or the charts that you see on the right. There is a displacement or a bullish fair value gap that occurs right before we purge this liquidity, okay? So this fair value gap now is a potential IFVG or a potential inversion fair value gap. Okay, so the next thing we want to see is price trade through and displace away from the fair value gap on a candle close basis. Okay, so we need to close below the bullish fair value gap on a candle close basis, displacing away from it. Okay, you see how we are forming bearish fair value gaps on the way out of the bullish one. There is also a volume imbalance here. Okay, so we are displacing away. Okay, the next element, we want to see a return to the potential inversion fair value gap. And finally, we want to see failure to close above it on a candle close basis. You see how price fails to close above the bullish fair value gap once it returns to it. So now this inversion fair value gap is this potential inversion fair value gap is confirmed as an inversion fair value gap, a real one. Okay. And next and final thing, we enter on the follow-up displacement. Okay. You see in the red box, another displacement forms, and that's what we use for our entry. Okay, we target the near sell side liquidity. And that's a wrap of the model. Very, very simple. And I hope you guys understand the model. Very, very straightforward. And let's deep dive into the charts now to see some practical examples. Right, here we are on the micro Nasdaq contract. And this is the price action from yesterday, April 14th of 2025. There was a perfect setup of what we just explained that formed at the 11 o'clock macro. Okay, you see how initially price was trading up during London right before market opened, and here you see your bullish displacement where price starts printing bullish fair value gaps or BCs. Okay, there is a high perched here, a high perched here. See that? Okay. Now, what we want to look for is these BCs that form right after a potential bearish breaker. Okay, once price displaces here during the 9:30 to 10 o'clock hour, we want to look for the fair value gaps or the BCs that formed right after potential breaker. So this series of down close candles are a potential breaker. Okay, so we want to watch that. These two down close candles are a potential breaker, and there is another BC here that formed right after that. So these breakers, they are confirming that these BCs which formed right after them are potential candidates for inversion fair value gaps. Okay, the upper one we obviously never trade to it, so we can disregard it, but the lower one, if we extend it to the right, once price starts returning back to it after 10 o'clock, so here, failure to return to it. Now, once we trade here at 1050 macro, so pay attention, 1050 macro, we start watching how price behaves around this potential inversion fair value gap. Okay, we have the potential breaker here and potential inversion fair value gap. So guys, the highest probability inversions, they have a breaker next to them. The highest probability breakers, they have a fair value gap next to them, which is a candidate to be inverted. So in a way, this breaker and this fair value gap, they are acting together to give you the strongest possible confluence, the strongest possible confirmation that this market structure shift here is valid. Okay, that this is a valid market structure shift. Okay, so once we return back to this BC, we want to watch how is price behaving around this BC. You see that price stops there. It tries 1, 2, 3, 4, 5 times and fails to break above this BC. So then, because we don't close above it, then we displace down. These two CBs are your displacement down. This is the signal that once we trade into the the lower BC, the first one, this is your high probability short now. Okay. So it's going to be on this candle. And once again, if you're conservative, put your stop loss above this the candle that formed the first BC, but the first BC, guys, is usually your breakaway gap. So we don't want price to trade there, but price can wick there. So we have to consider at least the midpoint of that CB. Okay, so we have to allow for our stop. We have to allow for our stop to be above the consequent encouragement of this first CB. So at least that. If you're aggressive, if you're not so aggressive, you can put it above the first CB or above the candle that formed the first CB. Okay, where you also have an order block. Okay, anyway, we're trying conservative here. We are targeting the obvious pool of liquidity, relative equal lows here. So that can be your initial target for a 2R, or alternatively, you can try this sell side, which was already formed during the opening range 947. Okay, so this will be a good candidate for your take profit. Okay, for 3R. All right, and we are entering right at the low of that CB. Okay, if you are more aggressive with a narrower stop loss, you can make it up to 4 or 5R on this setup. So you can see how powerful this is. Okay, this way we confirm, using the inversion fair value gap, we confirm that this market structure shift is in fact correct. We confirm that this here is a valid breaker. You see that? Let me mark the breaker. You see, we fail even to close above the breaker. Okay, so that's very, very strong confluence, and then we displace down. Okay. When you go back a little bit, let's go back a little bit in price and try to find other examples of this same thing. Okay. And it works both ways, of course, bearish and bullish. And you can see here another good example. It is a trade setup from London. We have the initial BC here, which is a candidate to be inverted. So once we displace away from it, we can confirm using this BC that this is a valid market structure shift. How do we confirm that? We confirm by waiting for price to return back to the potential inversion fair value gap, or this BC, fail to close above it. Ideally, you want it to fail even closing above the consequent encouragement. That's your ideal setup. If it fails to close above consequent encouragement, then it's really, really good. Okay. And of course, always, guys, always try to look for setups during macro hours. Okay, I can't stress that enough. Macros are key. The macros will give you the highest probability chance that your setup will play out. Okay, so once price fails to deliver above consequent encouragement of this fair value gap, then we wait to see how it behaves. We wait to see another displacement down. Okay, here you can argue that that's a displacement, but it's rather, it's not that it's not very good, but it's first of all, it's not during a macro. We trade into it right before macro hits, so that's not bad. Here at 450 we displace again out of it, so that will be for me personally a better setup, entering maybe here on this candle. But you can use this displacement as well because it's right before the macro starts. Okay, why I don't like it also is because of this bullish green candle here. So this whole range here is very much balanced except for this volume imbalance that formed here. Okay, so the volume imbalance is the only thing essentially right here. So let me remove that. The volume imbalance is essentially the only range that was not balanced here. And then price returns to it, balances the volume imbalance out, and then it displaces down. So you can enter on this second displacement. Your stop loss, however, if you're aggressive, is going to get hit here. But if you were to use a conservative stop loss above this candle, then you would have been just a, let me see, if we enter on this, yeah, it should have been pretty high up like this in order not to be stopped out. But once you're stopped out, you can just take the next displacement right here, entry, and then you can target these lows. Okay, so it will be here, targeting these lows. So that's another like 3 to 4 hour for you, even once you were stopped out on this retracement. So you can see how powerful these are. You can also see recognize fake market structure shifts. So in this case here, once price starts going up, you can implement the same logic and take, for example, this CB and see if this market structure shift here is valid. Okay, so you have the same thing here, leaving a CB, taking a pool of liquidity, leaving a CB, then displacing away from it, leaving this BC. On the return, we failed to close below it, but then there is no follow-up displacement on the way up. Price instead just turns over and starts displacing lower. This first displacement lower, that's your next setup. In this market maker sell model, you can target this low or ultimately this low because this one already took here. This one already took a pool of liquidity, so once we trade below it, we want to see price speed down to the next low. Okay, well, that's a subject for another video. Okay. Anyway, if we go a little bit back, we can try to find some other similar setups. So you can see the logic and really memorize it good in your head. And I'm sure that before long you'll be able to recognize these setups with your eyes closed. Okay, so here is another one. We are taking, first of all, key pool of liquidity, relative equal highs. Here on the way up, we leave a displacement, this BC, with a volume imbalance here. displacing away from it, then we wait for price to return, failure to close above the BC, and then we displace out of it again. And here is your setup. So this will be your entry short. Okay. Of course, guys, it has to come with the right narrative. If you blend this with the right narrative, you will absolutely find phenomenal setups. I can guarantee you that. But it has to come with the right context. Okay. So you use other ICT concepts on how to find liquidity levels, or for example, if you're using the one setup for life model from ICT, where you can trade this setup around previous sessions highs and lows, or around previous days highs and lows. Very powerful way to trade around these levels. Okay. So moving on, let's find another one. We can find maybe two more, and I'm closing the video. Okay. Let's see. All right, that's a good one. So you have relative equal highs here. Price trades down, takes this liquidity, takes a short-term low. Then on the way down, we have right after this breaker, so this will be your breaker, this green candle. Right after it, we have a CB that we actually failed to return to. So that's rather unfortunate. But if that was a tap, and then you can take the next displacement on the way up, which will be this one here. Okay, let's say 30, by the way, for an easy target here. Okay, so that would be like what is it? Let's see. That would be like a 2.7 hour. So and that's on a like 2 candles. Okay, 2 candles to the target. Very powerful. Okay. Driving in the fast lane. Okay, let's find one more, and then we are closing the video. So here you can see the same thing occurring. We're going down, taking this short-term low with ACB. Then we return back to it, trade out of it, return one more time. And even though we close below it here, this is where you can use the same logic to find entry later on. So you're not gonna enter on this BC because price already, the inversion fair value gap already failed here. ICT is calling that a little bit coloring outside the lines. But if you are not sure and you see this, you can wait. So price goes up. There is a small little BC here on the way out. But because this already occurred, we colored outside the lines. You can wait for price to return one more time into the inversion fair value gap. You see this failure to close below it and failure to even close below consequent encouragement. So that's actually what you want to see. And then on the next displacement up, you can enter. Sorry, that's for a short. You can enter long here. Your stop loss will have to be rather large because you have two BCs. You have to consider both of them, and then your next obvious pool of liquidity, because there is no obvious highs here that you can target. So the first one will be here. The first one will be here for 2.8R. And then the next obvious ones are those relative equal highs. That you can target to make it like a 4R. And ultimately, price trades even higher to take this one. Okay. But my personal advice, guys, and I know I myself have problem with this, I tend to overstay my welcome and hold for too long. So my personal advice and what I'm currently trying to implement into my trading is try to hit the low-hanging fruit. Okay, these are more often than not playing out. But the real home runs, when you can catch this entire run all the way to here for a 5 or 6R, more often than not, these might fail you, or your psychology might fail you because you have to wait for quite a long time. You have to wait for like an hour and a half before it plays out. Okay, so it's heavy on your psychology, on your mental capital. It's rather exhausting, and you might do some stupid mistake or not trail it properly. It can take you out and then continue without you if there is a bigger retracement. So my personal advice is find the low-hanging fruit objective and just target that. Okay, this one is very easy target. This one is easy target as well. Anything above it, because also this range here, you can see it's very much balanced. So anything above this level, for me personally, it's not worth the risk. It's not worth the wait. And at this point, by the time you're here, for me personally, you have to be either all out or 90% out of your position and trail aggressively. Okay. Okay, let's find one final setup and then we can call it a day. Okay. Let's see. Yeah, I can see this here. Very good setup. We have relative equal highs above, so that's your buy side liquidity. Here, price is trading to what? So let's give you a little bit more perspective. This candle, because it's such a large wick, you want to take consequent encroachment of the wick, okay, the midpoint. You see how price rejects this midpoint, okay? It takes liquidity here. So we do take liquidity, but we fail to trade below the midpoint. So that by itself is a high probability that we're gonna go long, and this is aftermarket. I know, I can see that, but nevertheless, this same thing plays out again. So you have the displacement on the way out, so that will be your breaker here. You have a displacement. Two CBs with a market structure shift here. So price returns and actually it opens right within the upper CB, trades to the lower one, and then it rejects. Okay, and on the way up, it leaves these two inefficiencies here. So if you trade the first one, let's say you are on your charts at this time and you want to trade it for some reason, you want to trade the aftermarket, and then you will enter on this first one like this, and you want to target these relative equal highs above your stop has to be, again, pretty conservative. So yeah, you can scrape like a 1.5 out of this, or if you're aggressive and do it like this, so stop loss below consequent encroachment of the second CB, something like that. You can scrape a 2R out of this. Okay. All right. And just let me take a look. This one is quite good as well. So let's do this one also, and then we're closing it. Here on the way down, we have shifting market structure. Okay, then we have a return to this CB, which is our potential inversion fair value gap, failure to close below it, and then we start displacing up. Okay, price is actually here trading so aggressively up, it doesn't give you a return to a fair value gap for quite a while. There is a small little imbalance here. If you are, that's actually right at 130. So if you are the one to spot these, you can trade that. If you're looking for a fair value gap, of course. You can trade that, or just wait for the next one that appears, and the next one is right here. There is a volume imbalance at the bottom, so you have to include that. So the next one will be right here. Okay, and since it's 130, you expect price to spool up. If you trade on this volume imbalance, your stop loss should be below the order block that formed here. And you can also use this volume imbalance, you can use this fair value gap as a measuring gap. So from the low, you take your fib, drag the equilibrium level or the midpoint all the way like to the low of this fair value gap, put your 0 and 1 level, and then you can project up the same range from here to equilibrium. You can project the same range up, see that that it coincides with this high, so you can trust this setup as a high probability long. Enter at the top of the fair value gap, target the high here with a stop loss below the order block low. Okay, so easy 3R. Okay, great setup. Anyway, guys, that's it for today's video. I hope you like my take on inversion fair value gaps and my personal favorite model, trading them. So if you have other ways to trade them, please leave a comment under the video. If you're new around here, please hit the subscribe button and help me build a community of ICT traders that want to learn, grow, and develop together. And that's it from me. Until I speak to you in the next one, I am out of here.